Over the last few years, headlines have obsessed over America's soaring debt. And for good reason. In 2024, the U.S. paid about $892 billion just in interest, more than most programs, and this year, interest is on track to be about 3.2% of gross domestic product, GDP, and bigger than defense and Medicare. But here's the twist. If you look beneath the surface, China's overall debt machine may be even larger and stranger, not always where you think it is, and not always labeled government. Today we're going to unpack that clearly with simple numbers, plain English, and zero hype. First, a framing that anyone can follow. The U.S. mostly borrows at the federal level. States and cities borrow too, but it's small relative to Washington's tab. Net interest costs have exploded as rates rose. And the Congressional Budget Office projects around $950 billion in interest in fiscal year 2025, on a path that eats a growing share of the budget. China distributes borrowing across layers: the central government, provincial and local governments, semi-public financing arms called local government financing vehicles, LGFVs, and state-owned enterprises, SOEs. Much of this sits off the official central government books, which is why the headline number can be misleading. Key point: when we compare debts, we must compare systems, not just one number. On paper, China's general government debt, that central plus recognized local government debt, is often reported in the 80 to 90% of GDP range in recent International Monetary Fund press estimates. But analysts warn that this misses off-budget local debt via LGFVs. Multiple reputable sources place LGFV debt in the $6 to $8 trillion neighborhood. That's roughly 45 to 60 trillion yuan, or 40 to 60% of GDP, depending on the year and exchange rate. The Atlantic Council and others have documented 44 trillion yuan of LGFV obligations by 2022 to 2023, and Rhodium Group estimated $7.6 trillion by mid-2023. Takeaway: local off-book debt is big and real. The Financial Times highlights the structural split: very low central government debt, very high local debt. Think of it as borrowing pushed down the pyramid. Then there are state-owned enterprises, firms the state owns outright or in part. China has thousands of them across every sector. Their borrowing is corporate debt, but the state frequently stands behind it in practice. Total non-financial corporate debt in China is enormous. Well over 150% of GDP in Bank for International Settlements data in recent years, and SOEs account for a large share. The exact SOE number varies by study, so treat any single dollar figure cautiously. What's not in doubt is that SOE leverage is heavy and systemically important. Simple translation: once you add recognized government debt plus hidden local borrowing, LGFVs, plus de facto public-backed SOE debt, China is economy-wide public sector adjacent debt gets very large. On some measures around or above 300% of GDP when you look at broad credit, what China calls total social financing, or TSF. As of mid-2025, TSF stood near 309% of GDP, up from approximately 303% at end 2024. Great question. As of this week, U.S. 10-year Treasury yield, about 4.16 to 4.22%. China 10-year government bond yield, around 1.75 to 1.80%. Why would investors accept lower yields in China if the system looks riskier? Capital controls. Many domestic institutions and savers cannot freely move money out to buy U.S. treasuries. That traps a lot of demand at home, keeping Chinese bond yields low. Limited alternatives. China's stock market has underperformed long-term, in part because state priorities often trump shareholder returns. With fewer attractive, safe options, buyers accept low bond yields. State influence. Major banks are state-owned or state-guided. They can and do support government funding conditions. These are structural features widely covered in market data and research. The yields cited above show the result. The U.S. economy is demand-heavy. Household consumption is approximately 68 to 70% of GDP. In China, it's roughly approximately 39 to 40%, far lower than the global average. That means China produces a lot but consumes relatively little at home. Where did savings go? Real estate. Chinese housing became the default asset for households. Affordability stretched to extremes. Beijing's price-to-income ratio often screens in the 2030s on popular datasets. signaling severe unaffordability compared with global peers. This creates a heavy drag, more saving to chase housing, less spending on everything else, and pressure toward deflation in consumer goods, something China has flirted with repeatedly over the past 2 years. Both systems create money, but the scale and channels differ. From 2000 to 2019, US M2 money supply roughly tripled. Over the same period, China's M2 money supply expanded more than tenfold, well into the teens on a strict ratio, reflecting a credit-heavy growth model. Despite that, consumer price index inflation stayed low, thanks to weak household demand and massive supply capacity. Plain English, China could create a lot of credit without sparking big consumer price inflation because people didn't spend much and factories kept prices down. The balloon bulged in property, not groceries. Households judge debt 2 ways: debt versus income and debt versus assets. For governments, we usually focus only on debt versus GDP because most governments don't own many liquid assets. The US federal government owns assets, land, buildings, equipment, gold. But Treasury's own report shows a negative net position on the order of tens of trillions once you include debt and long-term obligations. In short, not a lot of sellable assets to offset the debt. China is different. The state owns huge financial and non-financial assets, land leased long-term, big stakes in state-owned enterprises, and other holdings. International Monetary Fund research finds China's government has the largest stock of financial assets in the world, about $12.5 trillion 2019, and broader public sector net worth estimates by Chinese institutions show very large positive figures. The precise number varies, transparency is imperfect, and values move with markets, but the direction is clear. China's public sector has far more assets relative to its debt than peers. What that means, in theory, China can lean on assets, higher dividends, partial share sales, asset-backed financing to ease debt stress. Policymakers have started to talk and act this way in 2024 to 2025. Execution and transparency are the big questions. So, how bad is it? By broad credit metrics, total social financing, China's total credit load is approximately 300% of GDP and rising. That's heavy for a middle-income economy. If property weakness persists or deflation sticks, debt burdens get harder to service because incomes and prices don't grow. Fragmentation is a problem. Central borrowing is cheap. Local and SOA borrowing can be much pricier and less transparent, raising default and rollover risks at the edges of the system. For the US, the risk is different. Debt is mostly federal. Funding costs are high and interest now rivals or exceeds core programs. The US benefits from dollar dominance in the world's steepest bond market, but higher rates make compounding painful. Big lesson. This isn't a simple US bad, China good, or vice versa. They're vulnerable in different ways. A rupture between them creates 2 losers, not 1 winner. If you want a quick dashboard, US interest outlays versus revenue, are interest costs still climbing faster than tax receipts? 2025 points to tilde. $950 interest. China total social financing GDP ratio. If it keeps rising while GDP growth softens, leverage is outrunning income. China 10-year yield staying near approximately 1.7 to 1.8% signals ongoing policy support and weak alternatives. A sharp spike would be a stress signal. Property data and local finances. Watch local government financing, vehicle rollovers, and land sale revenues. That's the local oxygen tank. Debt isn't just a number, it's a system. America's system concentrates borrowing in Washington and pays a premium for it. China's system spreads borrowing across provinces, quasi-public firms and banks while leaning on state-owned assets and low yields to keep the machine running. Different paths. Different risks. Same rule, eventually someone pays.